Beatrice thought her retirement was boring, and she was proud of it. Boring to her meant predictable. 31 years of teaching 5th grade math in a suburb north of Detroit. A pension that deposited on the 1st of every month. A social security check on the 3rd. A variable annuity her husband Frank had bought in 2004 before he passed in 2018 that paid out quarterly. 2 CDs that rolled over at the same community bank where her father had banked before her. Boring, reliable, adult. The way she liked it. And then in January 2024, she got a letter from her annuity company explaining a change in how her required minimum distribution was going to be calculated going forward. The letter was 2 pages. She read it 3 times. She understood some of it. The parts she understood were worrying. She called her financial advisor, who admitted he was also still catching up on the specific details of the new IRS rules. He was not dodging her. He was being honest that the 2023 changes to how annuities interact with RMDs were one of the more technical pieces of Secure 2.0, and he wanted to make sure he understood before he advised her. Most retirees who own annuities inside retirement accounts have no idea the rules changed. The changes are real, they took effect in 2023, and they meaningfully shift how much you are required to take out and when. Some retirees benefit, some do not. All of them need to understand what is happening to their own situation. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What we are going to walk through today is the specific change, how it affects different types of annuities, and what you should check on your own annuity contracts. First, a brief foundation. An annuity held inside an IRA, or an employer-sponsored retirement plan, is subject to required minimum distributions once you hit your required beginning date, which under Secure 2.0 is generally age 73 for those born between 1951 and 1959. The annuity contract has to produce payments sufficient to satisfy the RMD for that portion of your retirement assets. Historically, this was handled in one of 2 ways. If the annuity was annuitized, meaning converted to a stream of periodic income payments, those periodic payments generally counted as satisfying the RMD for that contract, provided they met certain requirements. If the annuity was not annuitized and held in a deferred accumulation phase, the account value at year-end was used. To calculate the RMD, like any other IRA holding, the gap in the historical rules was how to handle the value of the annuity's future income guarantees, riders, and benefits when calculating the RMD for a non-annuitized contract. The IRS Regulation Section 1.401A.9.6 addressed this in 2005 and required that the actuarial value of these guarantees, including guaranteed minimum withdrawal benefits and guaranteed minimum death benefits, be added to the contract's cash surrender value when calculating the year-end balance for RMD purposes. The effect of this was that retirees with annuities featuring generous guarantees often saw RMD calculations that were significantly higher than what the cash value of the contract would suggest. A deferred variable annuity, with a guaranteed minimum income benefit rider, purchased years earlier when the market was different, might have a cash value of $200,000, but a guaranteed benefit base of $350,000. Under the old rules, the RMD calculation effectively used something closer to the benefit base, not the cash value, inflating the required distribution and accelerating the tax bill. Secure 2.0, signed at the end of 2022, changed this. Specifically, it modified how the IRS treats partial annuitization within a single retirement account. Under the new rule, which generally took effect starting in 2023, the value of an annuitized portion of an account can be aggregated with the non-annuitized portion for RMD purposes. What this means in plain English is that if you have an IRA with both a traditional investment portfolio and an annuitized annuity contract, you can now use the combined value to calculate the RMD, rather than treating the 2 pieces separately. The RMD from the annuitized portion can satisfy the overall RMD for the account, even if the scheduled annuity payment would have otherwise been more than or less than the RMD attributable to that slice. This sounds technical because it is, but the practical effect for retirees with annuities is meaningful. Under the old approach, an annuitized annuity inside an IRA often required you to take its income stream and separately take an RMD from any non-annuitized IRA assets. If the annuity income already exceeded what the RMD for that slice would have been, the excess did not help reduce the RMD from the rest of the IRA. The excess just sat as extra taxable income. Under the new approach, the excess can be counted toward the overall RMD. That lets retirees reduce or eliminate additional distributions from their non-annuitized IRA holdings, keeping more money compounding in the investment portfolio. Let me walk through a specific example to make this concrete. Joyce, a retired librarian from Illinois, has two buckets inside her IRA umbrella. A traditional investment account with $550,000 at year end. An immediate annuity she purchased 10 years ago that pays her $38,000 per year. Before 2023, her annuity payment of $38,000 was its own stream, and the $550,000 investment account generated its own RMD. At her age 75, using the uniform lifetime table factor of 24.6, the RMD on $550,000 is about $22,360. So Joyce was taking $38,000 from the annuity plus $22,000 from the investment account, for a combined $60,000 of IRA-sourced income. Under the post-2023 rule, the combined account value can be calculated, and the annuity payment can count toward the overall RMD. Her total IRA value, combining the actuarial present value of the annuity with the investment account, might be around $900,000. The RMD on $900,000 at factor 24.6 is about $36,600. Her annuity already pays $38,000, which by itself exceeds the total RMD. She would not need to take any additional distribution from the $550,000 investment account to satisfy her RMD for the year. The benefit, in dollar terms, is that $22,360 stays inside her investment account, continuing to compound tax-deferred, rather than being forced out, into her checking account where it gets taxed and sits in cash. Over a 20-year horizon, at an assumed 5% growth, keeping that $22,000 compounding each year, rather than distributing it, is the difference between a final account value of roughly $900,000 versus roughly $350,000, depending on a lot of assumptions. The math is big, the principle is simple. Forced distributions cost you compounding. This is a favorable rule change, and it is the piece that most retirees with annuities should understand. There is another piece of Secure 2.0 that is worth knowing about. The rules for qualifying longevity annuity contracts, or QLACs, were loosened. A QLAC is a deferred income annuity purchased inside an IRA or 401k that is excluded from RMD calculations until it begins paying. Previously, the maximum purchase amount for a QLSE was the lesser of 25% of the retirement account balance, or $145,000 indexed. Secure 2.0 eliminated the 25% cap and raised the dollar limit to $200,000, indexed for inflation. The QLSE payment start date can also be as late as age 85. The effect is that retirees with significant IRA balances can now shelter up to $200,000 of IRA assets from RMDs by purchasing a QLS, and that $200,000 will not generate required distributions until the QLAC begins paying. This is a niche strategy, but for certain retirees, it is quite powerful, particularly those who are concerned about longevity risk and want a guaranteed income stream later in life without the immediate tax impact of forced RMDs during their 70s. Harold, a retired truck driver from Minnesota, had a $1.1 million IRA. He worked with his advisor and purchased a $200,000 QLEC that will begin paying at age 83. That $200,000 is now excluded from his RMD base during his 70s. His RMDs during those years are calculated on the remaining $900,000 rather than the full $1.1 million. The annual RMD savings are roughly $8,000 per year during his 70s, which at his 22% bracket is about $1,760 per year. In reduced tax, and more importantly, the $8,000 stays inside the IRA compounding. When the QLEC begins at 83, it starts paying a much higher payout than what the $200,000 would have purchased at the time of purchase, because the insurance company had additional years to invest the funds and because of mortality pooling. Now, QLACs are not right for everyone. They are illiquid. The money you put into a QLAC is generally not accessible as a lump sum in an emergency. If you die before the payments begin, depending on the contract features, your heirs may receive a death benefit that is less than what the account would have grown to in a traditional IRA. The right QLAC decision depends on your overall situation, your health, your other liquidity, and your views on longevity. A third piece worth knowing about is that Secure 2.0 clarified that certain annuity features, including guaranteed minimum withdrawal benefits and lump sum payment options on annuitized contracts, are permitted within retirement accounts without triggering disqualification issues. Previously, there were concerns that certain riders might cause the contract to fail as a qualified annuity. The new rules provide safe harbor treatment for a range of features, which means insurance companies can offer more flexible annuity products inside IRAs without clients having to worry about adverse tax consequences. What does all this mean for you, practically? First, if you own an annuity inside an IRA or 401k, read any correspondence you receive from the insurance company carefully. Many companies sent notices in 2023 or 2024 explaining how they were applying the new rules. If you don't understand the notice, call the customer service line and ask. If the representative can't explain it clearly, call your financial advisor or a CPA who works with annuities. Second, request a year-end statement that shows both the cash value of the annuity and its actuarial value for RMD purposes. Your RMD calculation may have changed. Understanding the inputs is worth a few minutes. Third, review your RMD calculation for the year. Compare what you actually distributed against what you were required to distribute. If you took more than required from a non-annuitized IRA because your advisor or custodian was not applying the new aggregation rule, you may have distributed unnecessarily, though the excess cannot be put back. Going forward, the calculation should be more favorable. Fourth, consider whether a QLAC makes sense in your situation. If you have significant IRA assets, concerns about longevity, and other sources of liquid emergency funds, a QLSE can reduce your RMD base and provide a longevity hedge. If you have modest IRA assets and tight liquidity, a QLAC is probably not the right tool. Fifth, confirm your beneficiary designations on every annuity contract. Annuity beneficiary rules are their own complicated topic, and the stretch rules under the Secure Act affect inherited annuities as well as inherited IRAs. Non-spouse beneficiaries generally face a 10-year distribution rule, but the OIMWA specific rules for inherited annuities depend on the contract structure. Sixth, be aware that the actuarial value calculation for annuities with riders, death benefits, and guarantees is genuinely complicated. Different insurance companies apply the rules slightly differently. If your RMD seems dramatically different from what you expected, ask for the specific calculation methodology and have it reviewed. Seventh, pay attention to Form 10.99-R. Box 7 contains the distribution code, which for annuity payments is typically a 7 for normal distributions. Box 2A shows the taxable amount. Box 5 shows the amount that is a return of basis, which is non-taxable. On a qualified annuity inside an IRA, Box 5 is generally 0, because the entire distribution is taxable. On a non-qualified annuity purchased with after-tax dollars, Box 5 reflects the return of your cost basis, which is not taxable. Make sure the preparation of your return handles these correctly. There is a broader observation worth making about annuities in retirement. They are insurance contracts, and insurance contracts are designed to transfer specific risks from the consumer to the insurance company in exchange for a premium, often embedded in the contract in the form of expenses, caps, or reduced returns. An annuity can be the right tool if the risk you are transferring matches the risk you are genuinely worried about. Longevity risk, sequence of returns risk on a fixed income need, and market risk on a guaranteed income floor are all legitimate uses. An annuity can also be the wrong tool if the product is sold on fear rather than purpose, if the embedded costs exceed the value of the guarantees, or if the product is held inside a retirement account where some of the tax advantages of the annuity structure are duplicated by the retirement account structure itself. This last point, annuities inside IRAs, is a common critique, though the 2023 changes to the aggregation rules reduce some of the past objections about RMD-driven forced distributions. The right move, if you own an annuity and are over 60 or approaching retirement, is to have a neutral third party review the contract. A fee-only financial planner or a fiduciary advisor who does not earn commissions on annuity sales can look at what you own, what it costs annually in fees, what the guarantees actually provide in dollar terms, and whether holding the contract continues to serve your plan. If it does, keep it. If it doesn't, explore options, which can include holding the contract to the point where surrender charges are gone, exchanging into a lower-cost contract through a 1035 exchange, or annuitizing for income if that is the best use of the asset. Frank and Eleanor, a retired couple from New York, Frank, a retired postal worker, and Eleanor, a retired nurse, owned a variable annuity they had bought in 2003. Annual fees, including mortality and expense charges, rider fees, and sub-account expenses, totaled about 2.8% per year on an account value of $380,000. That was roughly $10,600 per year in internal costs. The guaranteed minimum income benefit rider was worth some value, but not $10,600 per year in their specific circumstances. A fee-only advisor ran the analysis, compared the cost of the existing contract against a lower-cost alternative with similar features, and recommended a 1035 exchange into a contract with fees closer to 1.1%. Annual savings were approximately $6,500. Over a 15-year remaining horizon, the savings were substantial, and the rider protections remained intact. Not all exchanges make sense. Surrender charges on older contracts can be steep. New contracts may reset guarantees to less favorable current market terms. The analysis has to be done contract by contract. The bigger picture, to bring this back to the 2023 rule changes, is that the annuity landscape is evolving. The IRS rules under Secure 2.0 generally made annuity ownership inside IRAs more flexible and more favorable, not less. The RMD aggregation rule reduces forced distributions. The QLSE expansion provides more room for longevity hedging. The safe harbor for annuity features provides more product flexibility. But the rules are also technical, and they are not automatically applied by every custodian or insurance company in every situation. The retirees who benefit the most are those who understand what they own, ask specific questions, and work with professionals who stay current on the regulations. If you own any annuity inside an IRA or 401k, or if you are considering purchasing one, the time to have a conversation with a qualified tax and financial professional is now. The rules in place today are different from the rules in place 5 years ago. What you were told when you purchased the contract may no longer be the best guidance for how to manage it going forward. As an expert who has worked through dozens of annuity and RMD situations over the years, my strong encouragement is this: do not let the complexity of the product keep you from understanding what it does, what it costs, and how it interacts with your broader retirement plan. Your annuity is not supposed to be a mystery you tolerate. It is a tool you own, and tools work best when the owner understands them. Take the afternoon. Pull out the contract. Write down the questions. Make the call. The clarity you gain is worth more than any specific dollar saved, because clarity lets you sleep at night. And sleeping at night is what retirement is supposed to be for. Take care, and I will see you in the next one.